You know that feeling when you're trying so hard to figure something out that you missed the obvious answer? I've been reading investment books for years. Since I started taking money seriously, I've read well over 100 of them. Every category, every guru, every strategy. The classics, everyone says you must read. The new releases promising fresh insights. But let me tell you about a specific 2-year period when I decided to go deep. I picked 43 books. The ones with the best ratings, the ones recommended most often. I didn't just read them, I took notes. I built spreadsheets. I tried to implement every strategy. At the start of those 2 years, my investment portfolio was worth $8,000. At the end, $9,200. 300 hours of focused study. $4 per hour. Less than minimum wage. Here's what really bothers me. Those books weren't just wasting my time. They were stealing my attention from what actually mattered. And today I want to show you why most investment books are designed to keep you busy instead of making you wealthy. It's not a conspiracy. It's just how the industry works. They answer the questions that sell books, not the questions that build wealth. Most books will teach you strategy, which funds to buy, how to allocate assets, when to rebalance, what expense ratios to target. These are strategy questions, tools and tactics. And strategy sells because it feels like progress. You're learning something new, taking action, checking boxes. But here's the problem. Strategy is the third layer. And most people never build the first 2 layers. So their strategy just floats in the air with nothing supporting it. The first layer is identity. Who are you trying to become? Not what do you want to have, who do you want to be? This is different than saying I want to be rich. That's vague. Identity is specific. Are you trying to become someone who doesn't panic when the market drops? Someone who can say no to a toxic boss? Someone who has options instead of obligations? This is the foundation. And almost no investment book starts here. The second layer is outcome. What do you actually want your money to do for your life? Not in theory, in practice. On a random Tuesday morning, most people answer with activities, not outcomes. They say, I want passive income. I want to beat inflation. I want to build wealth. These are activities, processes, verbs describing ongoing actions. An outcome is a specific state of being. Here's a test. If you achieved passive income tomorrow, what would actually change about your life on Monday morning? If the answer is vague, you don't have an outcome. You have an activity. Real outcomes sound like this. 3 months of expenses sitting in an account that lets you sleep without checking your phone at 2 a.m. The ability to take an entire summer off without asking permission. Sending your parents on a vacation they'd never spend their own money on. These are destinations. Specific places you can picture yourself arriving at. Only after you have identity and outcome should you even think about strategy, about which tools get you there. But most books start at tools, because tools sell. You can compare tools. You can optimize tools. You can feel smart discussing tools. It's like studying GPS route optimization without knowing where you're trying to go. You can find the most efficient route, the one with least traffic, lowest gas consumption, fastest time, but a perfect route to the wrong destination is still a waste of gas. I have a friend who teaches real estate investing. Every course, about 30 people sign up. First day he asks everyone why they want to invest in real estate. Out of 30 students, maybe 2 can answer with clarity. The rest say things like passive income, wealth building, financial freedom. So he pushes. If you had passive income tomorrow, what changes Monday? Most people freeze, because they've never actually thought past the activity to the outcome. They're chasing a process, not a destination. Here's something that took me years to understand. The most valuable information sounds stupid because it's so simple. Let me give you an example outside of finance. Fitness. If you want to be healthy, you need 4 things. Sleep 7 to 8 hours, walk 10,000 steps, eat enough protein. Do this consistently for years. That's it. No secret workout, no magic supplement, no biohacking protocol. Just 4 boring rules that everyone knows and almost nobody follows. Why don't people follow them? Because they're looking for a 5th rule, a secret technique, an optimization hack, something that feels like new information. And the fitness industry is happy to sell you that 5th rule, because the industry doesn't make money from you sleeping 8 hours and walking. They make money from complexity, from making you feel like there's always something more to learn. Investing is exactly the same. Morgan Housel wrote a book called The Psychology of Money. He condensed all of investing into 4 steps. Spend less than you earn. Save and invest the difference. Build a diversified portfolio. Be patient. That's everything. 4 sentences. And less than 5% of people actually do all 4. You know why? Because they're looking for the 5th step, the advanced technique, the insider strategy. I spent 2 years looking for that 5th step. It felt like progress, like I was getting smarter, but I was just avoiding the obvious. Now let me show you where books redirect your attention. For the last decade, 2 ideas have dominated investment advice. First, that volatility is your main risk. Books will tell you to minimize drawdowns, smooth out returns, manage standard deviation, build an all-weather portfolio. Second, that fees are your enemy, that a 1% management fee will destroy your wealth over 30 years, that you should only invest in funds charging less than 0.1%. Are these ideas useful? Yes. Are they what actually matters? No. Here's a better way to think about wealth building. You have an engine and you have leaks. The engine is your income power, your ability to earn money through career skills or business, your capacity to create value that other people will pay for. The leaks are your spending structure, your fixed costs, your lifestyle creep, the monthly subscriptions you forgot about. Volatility and fees are dashboard cosmetics. They're the paint job on your car. Sure, they matter eventually, but if your engine is weak and your leaks are large, optimizing the dashboard is just procrastination. Let me show you what this looks like with actual numbers. You have an $8,000 portfolio. You're stressed about volatility, worried that a 20% market drop would turn $8,000 into $6,400. So you spend hours researching asset allocation strategies. Or you're obsessed with fees. Your fund charges 0.5% annually. That's $40 per year. You find a fund charging 0.04%. That's $3.20 per year. So you research for 10 hours to save $36.80. That's $3.68 per hour for your time. But nobody's asking the real question. Why is your portfolio only $8,000? That's the engine problem. That's the leak problem. You're optimizing cosmetics while ignoring propulsion. In your first 15 years of investing, your savings rate matters approximately 10 times more than your returns. This isn't opinion, it's mathematics. Person A starts with $8,000, saves $500 per month, gets 10% annual returns, pays rock-bottom fees of 0.04%. After 10 years, they have $106,000. Person B starts with $8,000, saves $1,500 per month, gets 8% returns, pays expensive fees of 0.5%. After 10 years, they have $250,000. Person B has more than double, with worse returns, higher fees, zero optimization. The only difference is deposits, more money going in. That's the engine. But books won't focus on this because there's no product to sell. They can't write a chapter on how to save $1,000 more per month. That's not investing advice. That's career advice, life advice. But it's the actual answer. Optimization is what you do when you're avoiding expansion. Now let me tell you about a problem nobody warns you about. Every piece of financial advice is optimized for a specific decade. Your grandparents in 1975 would tell you to get a job with a pension, buy a house in the suburbs, put money in a bank account paying 5% interest, stay at one company for 30 years. This was correct advice. It worked, but it was advice for that specific era. The 1990s day trade tech stocks. Get in early on IPOs. Everyone's getting rich in the market. You should too. This also worked. For a while. Then 2000 came. The 2000s. Buy real estate. Flip houses. Get multiple properties. Real estate only goes up. Leverage everything. This worked spectacularly until 2008. My grandmother told me in 1990 to put everything in a CD at the bank. CDs were paying 8 to 10%. Zero risk. Smart move. Today, CDs pay 0.5% while inflation runs at 3%. You'd be losing money. The world changes. Technology changes. Economic conditions change. What worked for your parents probably won't work for you. What works for you probably won't work for your kids. Every piece of advice has an expiration date. Your job is to date stamp advice before you obey it. Ask, when was this true? Under what conditions do those conditions still exist? Most people don't ask. They just follow because a book said so or a guru recommended it. The most recommended investment book of all time is The Intelligent Investor by Benjamin Graham. Everyone puts it at number 1. Warren Buffett recommends it. Every finance blog recommends it. And most of the people recommending it treat it like a manual, like a set of instructions you should follow today. But here's the truth. It's not a manual. It's a museum. You should read it for the philosophy, for understanding how great investors thought about markets. Not for the formulas. Not for the specific techniques. The market Graham operated in doesn't exist anymore. Information moves slowly. Inefficiencies lasted for months. You could find undervalued companies using simple math. Today, information spreads in milliseconds. Algorithms process news faster than you can read a headline. The specific strategies don't work, but the principles do. The idea of margin of safety, the concept of Mr. Market and emotions. These stay true, but people waste months trying to apply 60-year-old formulas to a completely different world. So if advice expires, what actually stays true? Survival principles. That's what doesn't change. Investing isn't really about getting rich. It's about surviving long enough for time to work. Surviving market crashes without panic selling. Surviving your own emotions when everyone around you is making money and you're not. Surviving long enough to actually enjoy what you've built. But survival knowledge doesn't live in investment books. It lives at the intersection of multiple fields. You want to understand money? Read about luck and randomness. Nassim Taleb wrote books like The Black Swan and Anti-Fragile. They teach you the world is more unpredictable than we admit, that rare events matter more than average outcomes, that surviving the unlikely is more important than optimizing the likely. Read about cognitive biases. Daniel Kahneman, Thinking Fast and Slow. Your brain is wired to make terrible decisions with money. Knowing this doesn't fix it. But you can build systems that protect you from yourself. Read about health and longevity. Warren Buffett's real secret isn't his stock-picking skill. It's that he's been investing for over 70 years. He survived long enough for compound interest to do ridiculous things. If you want investment success, step 1 is don't die. Stay healthy. Manage stress. Sleep well. Live longer, invest longer. Read about minimalism and enough. Your life gets dramatically easier when you figure out what enough looks like. When you stop keeping up with people who are keeping up with other people. This isn't soft advice. It's a survival strategy. Here's something investment books can't tell you. The stock market doesn't make people wealthy. It helps wealthy people stay wealthy. There's a difference. Wealth gets created outside the market. Through businesses, skills, creating things other people value, solving problems. The market is just where you park the wealth you've already created, so it doesn't disappear to inflation. Think about it like maps and territory. The investment industry sells maps, tools for navigating markets. But maps aren't territory. Value creation is territory. And you can't build wealth by only studying maps. People love to criticize Robert Kiyosaki. They say he made his money from books about real estate, not from real estate itself. But that's exactly the point. He created something valuable. Millions of people bought his books. That's value creation. That's how wealth actually works. You create something, people pay you for it. Then you invest that money so it doesn't lose value. The market is step 2, not step 1. But investment books are written by people in the investment industry. They're fund managers, financial advisors. They can't tell you that real wealth happens outside their industry. It would be terrible marketing. Now let me talk about something that makes people uncomfortable. The most popular investment strategy right now is passive index investing. Buy low-cost funds from Vanguard, BlackRock, or Fidelity. Hold forever. Don't try to beat the market, just match it. This is genuinely good advice. I follow it myself, but here's what's quietly happening. More than half of all invested capital in the world is now controlled by 3 companies. 3. That's it. Trillions and trillions of dollars, all flowing through the same plumbing. Think about index funds like plumbing. Critical infrastructure. Mostly invisible. Works great most of the time. But plumbing is only reliable until it clogs. And when half the world's money flows through 3 pipes, you've got concentration risk. What happens if one of these companies makes a massive error? What happens when that much money tries to move in the same direction at once? I don't know the answers. I'm not predicting disaster. I'm just saying that when everyone's doing the same thing, we should at least acknowledge the risk. This isn't fear-mongering. It's humility about systemic concentration. So should you read investment books? Yes. But understand what they can and can't do. They can teach you tactics, explain concepts, give you frameworks for thinking about markets. But they can't answer your identity question. They can't tell you what outcome you're actually chasing. And they definitely can't make you wealthy. Because wealth comes from doing obvious things that everyone knows, but almost nobody actually does. The most valuable information is simple and boring. Spend less than you earn. Save the difference. Invest it. Be patient. Let time work. Focus on what you control. How much you save. How long you stay invested. How you behave when markets drop. Ignore what you can't control. Where markets go tomorrow. What other investors are doing. Whether this month is up or down. None of that matters if you're building over decades. But simple and boring doesn't sell books. So the industry gives you complexity, advanced strategies, optimization techniques, secret methods, and you waste years studying tools while never answering the first question. Who are you trying to become? What outcome are you actually chasing? Which destination makes all this effort worthwhile? Books can't answer these for you. Only you can. Here's what I wish someone had told me when I had $8,000 and was reading my 10th book about expense ratios. Stop. Put the book down. Answer 3 questions first. Who do I want to become? What specific outcome am I chasing? What would have to be true about my income and spending to get there? Then pick the simplest possible strategy. Total Market Index Fund. Automatic deposits. Time. That's it. No complexity. No optimization. No advanced techniques. Just engine power and leak management over many years. Your future self is looking back at you right now. From 5 years ahead. From 10 years ahead. They're not hoping you read more books. They're hoping you'll figure out what actually matters. That you'll stop optimizing an $8,000 portfolio and start asking why it's only $8,000 in the first place. That you'll stop studying maps and start creating value and territory. That you'll answer identity and outcome before you touch strategy. Books are fine. They're useful. But they're not a substitute for deposits and time. They're not a replacement for doing the obvious, boring work that everyone knows but nobody wants to do. Reading feels like progress. It feels productive. But doing is progress. Deposits are progress. Patience is progress. Everything else is just noise that keeps you busy while time passes. Don't let 100 books steal another 2 years of your attention. Figure out who you're becoming and what you're building. Then do the simple thing and give it enough time to work.